Good evening, students. I hope you have revised whatever we had done in the last lecture. We had covered some specific taxation provision for the non-resident. We had talked about non-resident Indian, how their taxation and their tax rates are in place under our Income Tax Act. We had talked about foreign institutional investors, a sports person or a non-resident who is earning income from performances. We had also seen the first proviso to section 48, right? So if you have any doubts with respect to previous session, you can ask me, or in this session, we would be proceeding towards one topic which is left on section 195 and then capital gains on ADR, GDR, and then we shall proceed to AR and double tax relief class. So if you have any doubts specific to the last lecture, you can ask me now itself, or we shall proceed further. I have already shared the last lecture's notes also. Good evening, Tushar. Okay, so let us proceed now then to the last part. Okay, so first of all, I'm talking about ADR and GDR, American Depository Receipt and Global Depository Receipt. Let me open up that. Now, what are these American Depository Receipt and Global Depository Receipt? You know about it. You have already learned in SFM that when you have to list the shares on the foreign stock exchange, you list it through the issuance of these American Depository Receipt or Global Depository Receipt, and then these receipts are traded, right? Now, how their taxability happens, as in when the capital gains are earned on this ADR and GDR, so how their taxability usually happens. So ADR and GDR purchased in a foreign currency by a non-resident, the capital gains, long-term capital gains, if one non-resident transfers to another non-resident, then in that case, it will be considered as exempt transfer under section 47(7)(a). And the period of holding for that is considered to be 36 months. The period of holding is considered to be 36 months. Okay. It is not a share. It is GDR. So we do not consider 24 months for unlisted share because this is not a share. This is ADR and GDR, and therefore the period of holding would be 36 months. If one non-resident transfers to a resident, then it is taxable at the rate of 10%. If it is a short term, then it is taxable at the normal rate. Dividend on this or interest from this is taxable at the rate of 10%. No Chapter 6A deduction is allowed. No first and second proviso, that is no foreign exchange fluctuation is allowed. No indexation benefit is granted. And ROI is not to be filed if taxes are duly deducted on the same. Now, what is the procedure for that? Let's understand how exactly these ADR and GDR function. So first of all, I'm talking about redemption of GDR into underlying shares. Okay, redemption of GDR. If you are redeeming the GDR and taking these underlying shares, then in that case, the fair value of consideration would be the value of shares, because you are exchanging the shares by giving up the GDR. You are taking up the shares by giving up the GDR. So full value of consideration for the exchange of GDR would be the value of shares received. Cost would be cost of GDR. Correct? Period of holding, as I said, would be 36 months. And tax rate the normal tax rates would usually apply. The normal rates would usually apply, because here I am talking about redemption of GDR. In this slide, I had talked about transfer of GDR to one non-resident, it is exempt. Transfer of GDR to a resident is taxable at 10%. Here I am talking about redemption of GDR. So redemption of GDR would be taxable at the normal rates. Would be taxable at the normal rates. Clear? If, say for example, the shares which I have received, I'm selling up those shares. So subsequent sale of shares, in that case, the full value of consideration would be the sale price of shares, right? Cost would be what? This is, I'm talking about the shares. So I have taken, say for example, GDR of Reliance. I'm redeeming those GDR and getting the shares of Reliance Industry Limited. And now I'm making the sale of those shares of Reliance Industry. Then in that case, the full value of consideration would be the sale price. Cost would be what? Cost would be this. Fair value of consideration, which was taxed while we were computing the capital gain in the case of redemption of GDR. This will be my cost. So fair value, full value consideration of GDR would be my cost. Why this is so? Because this has been already taxed. This part has already been taxed while computing the redemption. Now, while I'm selling the shares, I should take that higher value. Is it clear? So capital gain, long term or short term, what would be the period of holding? Period of holding here would be 12 months. Period of holding would be 12 months. Why? Because period of holding is computed in this case for the shares. In this case, it is for the shares. Clear? And tax rate would be under 111A for listed shares, 15%, or it would be under 112A for listed shares, long-term capital gain. Short-term 15%, long-term 10%. Clear? Is it clear? Any doubts do you have with respect to this? Any doubts? Tushar, I have shared already. They would be uploaded. Yes, Tushar, GDR should be purchased in the foreign currency. Good evening, Anjali. GDR should be purchased in the foreign currency, Tushar. So this is the chart I have prepared. Sale of GDR, transfer to non-resident, not a transfer. If it is transferred to resident, 10%. Redemption of GDR, you will have to pay tax at the normal rates. Clear? And the period of holding would be 36 months and not 12 months. Sale of shares, the period of holding would be 12 months. And the cost would be the full value of consideration of the GDR. Clear? We'll solve one small sum on this. I'll give you the sum. Let's see. So, Mr. Roy, a non-resident, purchases in convertible forex, in convertible foreign exchange, following GDR. ICICI Bank, date of purchase 1st June 2012, or make it 1st June 2030. Number of units 100. Price per unit 500. Dividend received on 31st May 2020, 40,000. Sterlite Industry, 1st May 2015. Number of units 100. Price per unit 400. And dividend rupees 30,000. Collection charges rupees 5,000. Next, Reliance Industry Limited, 1st April 2020, 200. Price 300. No dividend. Details of GDR sold. ICICI. One sec. Details of GDR sold. ICICI, Sterlite and Reliance. Sold to Mr. P, non-resident, Mr. X, resident, Mr. S, resident. Date of sale 30th June 2020, 30th June 2020 and 31st December 2020. Number of units 100, 100 and 100, 200. Price per unit 900, 700 and 800. So you are required to compute the capital gain for this. So quickly tell me in your chat boxes, what do you think for this? What will be the amount of capital gain? For ICICI, what will be the amount and what will be the tax rate? Yes, Ambika, right. What about Sterlite and Reliance, Ambika? Yes, Tushar, right. Quickly tell me what will be for Sterlite and Reliance. Yes, Tushar, perfect. But I think Tushar for STCG you have missed 1-0. Okay, so let's solve it together. So first, ICICI, it is from one non-resident to another non-resident, right? So in that case, this will not be a transfer under section 47(7)(a), right? For Sterlite is transferred to resident. So what will be the full value of consideration? Full value of consideration is how many shares are sold of Sterlite? 100. So 700 into 100. 70,000, right? Less cost of acquisition was how much? 400. So 400 into 100, 40,000, right? This will be the long-term capital gain as period of holding more than 36 months. Period of holding is more than 36 months. We have purchased in 2015 and sold in 2020, right? So this will be 30,000. First proviso to section 48, whether it would be available? The answer is no. First proviso to section 48, the exchange currency fluctuation will not be available for GDR. It is only available for purchase of shares of an Indian company, right? It will not be available for the purchase of GDR. Whether indexation benefit will be granted, the answer is no. Now this will be taxable at the rate of 10% plus cess. Clear? What will be the case of Reliance? Reliance, what will be the full value of consideration? Again, it is transferred to a resident, right? So full value of consideration will be how many shares are sold? 200 into 800. 1,60,000. Cost of acquisition is how much? Cost of acquisition is 300, right? So that will be 60,000. And this will be the short-term capital gain as period of holding is less than 36 months. This will be 1 lakh. Clear? And this will be taxed at normal slab rates. Dividend of 70,000 at the rate of 10% plus cess. Is it clear? Any doubts? Yes, Dhanush. Perfect, Ambika. Is it clear? Okay, let's solve one more sum. Let's solve one more sum on ADR GDR. Mr. Roy, a non-resident, purchased 1000 GDR of ICICI Bank on 1st April 2018 for rupees 2000 each. On 30th June 2020, he requested redemption or conversion of GDR into shares. Listed price of shares on BSE was rupees 3000 each. On 30th December 2020, he sold shares of ICICI Bank for rupees 3500. Compute the capital gains. So quickly tell me, in this case, what would be the capital gains? What will be the capital gains in this case? No, Sandeep. Yes, Tushar. Perfect. Perfect answer, Tushar. No, Sandeep. No, Preeti. Gomati, right? That is about redemption. What about sale of shares, Gomati? Perfect, Ambika. But what about the tax rates, Ambika? No, Preeti. Okay, so let's solve it together. First of all, there are two scenarios here. One is redemption and another is sale of share, which I had taught you in the last slide which we had done, right? So first I am talking about redemption. Right? Now for redemption, what will be the full value of consideration? I told you full value of consideration is the value of shares received, right? Value of shares received. Now what was the value of shares on the BSE on that day? 3,000. Right? 3,000 into how many GDR was sold? 1,000. So it becomes 30 lakhs. Cost of acquisition is the same. 1,000 GDR into 2,000. So 20 lakh. Now, whether this is long term or short term, when it was purchased, GDRs were purchased in 2018 and sold in 2020. So this is short term capital gain as it is period of holding is less than 36 months. Right? Now this will be at the slab rates. Taxed at slab rates. Right? Now, what would be the taxation here? 1,12,500 plus cess at the rate of 4%. Clear? Now, coming to sale of shares, the subsequent sale of shares. Full value of consideration would be 3,500 into 1,000. Here I am assuming that on redemption of 1,000 GDR, I have got 1,000 shares itself. So that makes it 35 lakhs, right? Less cost of acquisition for shares would be this price, 30 lakhs, right? This is what I told you. So this will be 5 lakh. Now whether this is long term or short term, the GDR were redeemed on 30th June and the shares are sold on 30th December. So this is short term capital gain as period of holding less than 12 months. Clear? Now this were listed shares, so taxed under section 11A at the rate of 15%. Right? This makes to 75,000 and then cess at the rate of 4%. Is it clear? Did you understand your mistakes? Those who didn't get the answer. Ambika, your tax amount is not correct. Did you get your mistake, Ambika? Kunal, your tax amount is not correct. Did you understand your mistake? Yes, Anjali, your answer was right. Shalini, it was not LTCG 15 lakhs. Now, did you get the answer? Rohita, yes. Short-term capital gain amount is correct. You have not given me redemption amount. Preeti, did you understand? Perfect, Preeti. Ambika, did you get your mistake? Sandeep? Any doubts do you have? Okay, Ambika. So shall we proceed further? If you have no doubts, the last part I'm just covering up, which is section 195 now. Now, what is section 195? So TDS while making payment to a non-resident, right? For resident, you have the section 194J, 194C, but for non-resident, whenever payments are made to non-resident, the tax is required to be deducted under section 195. So this section applies in case of any person responsible for paying interest other than interest under section 194 LB, LC or LD, or any other sum chargeable to tax other than salaries. So if a sum is chargeable to tax or interest payment other than this 194 LB, LC or LD, and other than salaries, because salaries is covered under 192, it is not covered under 195, right? To a non-resident individual or a foreign company is liable to deduct the tax at source at what rate? So rates, they say, as prescribed under the Finance Act. Rates prescribed under the Finance Act. Now, what are the rates prescribed under the Finance Act? There could be the special rates prescribed under the Finance Act, the special rates which we have done it here. What were the special rates which we had done? Say, for example, for interest, royalties, FTS, dividends, tax rate were given under section 115A. For LTCG, it was given under 112A. So these are some of the special rates which are given under the Act itself, right? Those are prescribed to the Finance Act also, and which are specifically laid down under Income Tax Act. So if there are specific sections which provide for specific tax rate like 115A, which provided for interest, royalties, FTS, then that rate will be applicable. If not, then the rates under the Finance Act which are generally applicable to individual, which are the slab rates. Clear? Or rate applicable to foreign companies, 40%. Clear? So that will be the rate which will be applied, or another rate which would be applied is the rates specified under the double tax avoidance agreement. So while you are deducting the tax under section 195, which rate will apply? Here they have not given one specific rate. They say the tax rate will be rate under the Act, which could be special tax rate under 115A, 112A, 111A, all of these, or general, which are the slab rates, or rate of foreign company, right? Or the rates under DTAA. Now, out of this, here under special or general, we will have the specific prevailing over general. If the specific rates are provided, then that will prevail over the slab rates, right? But between this and this, whichever is beneficial to assessee, whichever is beneficial to assessee. So if the rate under the Act is more beneficial to assessee, then the tax rate under the Act will apply. But if the rate under DTAA is say 5%, but the rate under the Act is say 10%. So say for example under Act, under 115A for royalties, say the tax rate is 10% plus 4% cess, but rate under DTAA is 5%. Then TDS under 195 will be deducted at which rate? At the rate of 5%. Clear? TDS will be deducted at the rate of 5%. Clear? So in this case, whenever a payment is made which is chargeable to tax other than salary, then in that case, the tax rate would be computed like that. Clear? So here, a person could be a resident or a non-resident, the payer. Payee has to be always a non-resident, right? Payee will always be a non-resident individual or a foreign company. But in case of the payer, a payer can be a resident also, a payer can be a non-resident also. We understand when a payer is resident, right? We understand when a payer is resident. But in which situation can a payer be a non-resident as well as payee be a non-resident? What would be that situation? So do you remember we had done the example of Vodafone for indirect transfer? Do you remember that? There we had seen Hutch was, Vodafone was making payment to Hutch. Vodafone was making payment to Hutch for purchase of shares of Hutch Mauritius. Do you remember that? And the shares of Hutch Mauritius derive their value substantially from Indian assets. Therefore, indirect transfer provision was applicable. Do you remember that? But in that case, both the parties were non-resident, Hutch as well as Vodafone. So Vodafone was making payment to Hutch. In that case, Vodafone was issued the notice. Hutch was not issued the notice. Notice was issued to Vodafone in that case. Why? Because while making the payment, Vodafone did not deduct the taxes. So it was treated as assessee in default under section 201. Therefore, this particular section at that time was amended. It was said that when one non-resident is making payment to another non-resident, when Vodafone was making payment to Hutch, in that case also TDS under section 195 will apply. TDS under section 195 will apply. Clear? Is it clear? So TDS will apply in case of payment by a resident or a non-resident to another non-resident. And this is irrespective of the fact that the payer non-resident is not having any presence in India, would not be having any place of business in India, clear, or residence in India. Clear? Now, deduction has to be made at the time of payment or credit, whichever is earlier. Is it clear? Any doubt? Any doubt now? Now even dividends will also attract TDS under section 195 because earlier dividends were exempt, but now it is chargeable. Any doubts? Yes, Anjali, tax on redemption will always be a normal slab rate if it's a short-term capital gain. On only sale, we have the 10% rate, but for redemption, it will be always the normal slab rates, whether long-term or short-term. For long-term, usually you have the tax rates under 112, right? You have the tax rate under 112. So that tax rate would apply. But for short-term, you have normally the slab rates. Clear, Anjali? Ankush, I didn't get your question. So if DTAA is applicable to a foreign company, then rate will be 30%. Why, Ankush, you are saying that tax rate for a foreign company is always 40%? Clear, Anjali? For long term, on redemption, it will be 112, and for short term, it is slab rates. Now, understand one thing, when a TDS is deducted under 195, then say for example, the non-resident may not have a taxable income in India, or for that matter, say for example, non-resident has a lower income in India, then he can always obtain a certificate for non-deduction or lower deduction of tax at source, like the normal sections which we have. So he can make an application to AO. For example, the non-resident himself can make an application to AO, the payee, or even the payer can go and make an application to the AO for determining the tax rate on which the on the payments which are to be made to the non-resident. Clear? So a certificate can be obtained from the AO by either the payee or the payer. Even the payer can make a certificate, make a request to the AO to grant him the certificate for determining the sum chargeable to tax. So this is usually in the case where, like for example, there is capital gain situation. Say for example, I am purchasing a property from a non-resident, right? Now that non-resident, I will be paying him the sale consideration, right? I'll be paying him the purchase value of the property. But would the TDS be deducted on the entire purchase value? The answer is no. Why that is so? Because the TDS is ideally to be deducted on the sum chargeable to tax. On the sum chargeable to tax. What is sum chargeable to tax? The capital gain amount. I will not come to know what will be the capital gain of that non-resident because I will not be knowing at what amount he had purchased the property. So in that case, I can make an application to AO to determine for me what will be the sum chargeable to tax. Clear? Also, in this case, the payer has to furnish the information to the income tax department of the payments being made to the non-resident and the tax being deducted on that in Form 15CA and Form 15CB. So that is required to be done whenever the taxes have been deducted or the payments are being made to a non-resident. Clear? Is it clear? Also, in this case, the refunds can be obtained of the excess tax deducted where, say for example, the payer has deducted the tax at a higher rate than the rate which is applicable under the Act. Or he was aware that, say for example, the tax rate under the DTAA would have applied, but the DTAA tax rate would have been higher. So in that case, he can obtain the refund of the excess tax deducted. Is it clear? Any doubts? Tushar, 194C and 194J are not applicable to non-resident. They are only applicable to resident. Okay, Preeti, I'll summarize quickly the special tax rate sections. Ankush, the foreign company is taxed at 40% under the Act itself. DTAA does not give any tax rate for the foreign company. So in that case, DTAA says that the foreign company will be taxed as per the Act itself. Okay. And DTAA gives only the rate in case of interest, royalties, dividends like that. So usually under the Act only, under our Income Tax Act prescribes a 40% tax rate. 30% is for the resident companies. Resident domestic companies are taxed at the rate of 30%. The foreign companies are always taxed at the rate of 40% under the Income Tax Act. The DTAA may provide for a lower rate of 10% if, say, for example, the income is FTS or royalty or interest. In that case, the 10% beneficial rate will apply. But 30% is only applicable for the domestic companies. Clear, Ankush? Tushar, treatment of dividend in 115 AC, I told you it was 10%. Preeti, if the rental income is, say for example, being paid to a non-resident is less than the slab rate, because you are asking me that if the payee is not chargeable to tax only, right? In that particular case, he need not deduct the tax because it is, then you will apply slab rate. Then there is no special rate which is applicable, right? So if slab rates are applicable and if he's falling below the slab, then there is no requirement of deduction of TDS. Because there is no particular tax rate attributable for rental income. Rental income are chargeable at slab rate, Preeti. Clear? Yes, Pooja. I'll also explain you what kind of questions will come for DTAA. Any other doubt? So, Preeti, for you, I'm just again revising once again the special tax rate applicable for non-resident. We had done the first proviso to section 48. That's just a computation mechanism for computing the capital gain. If the shares are acquired in foreign exchange, if the shares of Indian company are shares or debentures of Indian company are acquired in foreign exchange, then exchange currency fluctuation benefit is given. Now coming to the special tax rates which we had done the special provision for non-resident Indian under chapter 12A, wherein the LTCG on specified assets. What were the specified assets? Shares of Indian company, debentures issued by Indian company, deposits of public limited companies, NSC, all that LTCG on that would be taxable at 10%. Any other investment income like interest, dividend, that will be taxable at 20%. Clear? LTCG on assets other than specified assets would be taxable at 20%. LTCG on specified asset, 10%. LTCG on other than specified assets, 20%. Investment income, interest, dividend on specified or non-specified assets would be taxable at 20%. But the shares should have been purchased in convertible foreign exchange. No chapter 6A deduction, no any other deduction. You need to file ROI. You need not file ROI if the taxes have been duly deducted. This provision for only non-resident Indian. Non-resident Indian. If they sell the shares and if they repurchase some other company's share within 6 months time frame, then a deduction like 54F was allowed under 115F. A special deduction was allowed under 115F from capital gain. Clear? Then we moved to other section which was applicable was in the case of ADR, GDR we did today. ADR and GDR, I told you that if you are purchasing the GDR in foreign currency, ADR, GDR, you are purchasing in foreign currency, then in that case, if you are selling to one non-resident is selling to another non-resident, it is exempt under 47(7)(a). If you are selling to resident, then 10%. If you are selling to resident, then 10%. Period of holding would be 36 months. Dividend and interest would be chargeable at the rate of 10%. Clear? If you are redeeming the GDR, then in that particular case, what will be the tax rate? It will be the normal tax rates. Normal tax rate for short-term capital gain, it will be slab rate. For long-term capital gain, it will be under 112. The long-term capital gain will be covered under 112. Clear? And if you are making the subsequent sale of GDR, in that very case, what will be the taxability? In that case, it will be 111A for short term and 112A for long term. Is it clear? 111A for short term and 112A for long term. Clear, Preeti? And then we have the other section which was applicable was in the case of FIIs. For FIIs, we had the separate tax rates which were applicable. I had given you the table. I'll open it again. So, in interest under section 194 LD, 5%. Short-term capital gain under 111A listed, 15%. Other than that, 30%. Long-term capital gains on listed, 10%. And income from transfer of securities other than listed, long-term capital gain other than listed, again 10%. Clear? So this was for FIIs. So these are the special provisions which I covered. For non-resident sports person also I covered in the last class, which was taxable at the rate of 20% from income from performance or participation in any game or sports. Clear? So this summarizes your entire special provision section. Is it clear? Any doubts? Kunal, we are just starting with that. No, Sandeep, for elective paper, separate studies required because that is very much comprehensive. Just tell me one thing, if on redemption of GDR ADR, when I say 112, if redemption of ADR GDR long term is taxed under 112, what will be the tax rate according to you, whether it will be 20% or 10%? What will be the tax rate in that particular case, whether it will be 20% or 10%? On redemption of GDR I'm talking about, when the shares are when the GDR is redeemed and shares are received, whether 20% or 10% tax rate would apply. What do you think? Under 112 in case of long-term capital gains on redemption of GDR. What do you think? Whether it will be 20% or 10%? Yes, Tushar, 10%. Because it will be unlisted securities. It is not shares, but it is unlisted securities, and 112 says for unlisted securities, it is 10%. So on redemption of GDR, if it would have been a long-term capital gain, then it will be 10%. Clear? So it will be 10%. In this case, I am talking about. So here, if it is short term, it will be slab rates, and long term, it will be 10% under section 112. Clear? Okay. So now I'm starting up with the DTAA part. Let's move into that. Now, what is this double tax avoidance agreement? Let's understand that very clearly. So say for example, I am a resident of India. I am a resident of India. I am earning some income from USA. Say for example, I am earning some income, some professional income from USA. I am taking up online classes for some US students also. Now, US would say that while the payment is being made to you, that payment is deemed to accrue or arising in USA because it is generated from the students of USA. So therefore, the source of income is in USA. And USA will say, we will deduct your tax. USA will say, we will deduct your tax, right? I am a resident of India. Now, India will say, as per section 5, global income of my resident is chargeable to tax in India. Now, what will happen if global income of a resident is chargeable to tax? India will also include the professional income derived from USA. Then in that case, India will also tax that same income. USA will also tax that same income. There will be a double tax which is happening. So to avoid that, what India will do is, India will enter into a double tax avoidance agreement with USA, wherein they will decide mutually as to how they will tax a particular income. And India will grant some taxing rights to USA. India will say, USA, you can tax it. You can tax this income. And what I will do is, to avoid double tax, what I will do is, India will say, I'll allow the refund, I'll allow the relief to my resident. How India will allow the relief? India will grant the credit of taxes paid in US. India will allow the credit of taxes paid in US. Clear? So what India will do is, whatever the taxes are paid in US, India will say, I'll grant you the credit for that. So against the Indian tax, the credit would be allowed of the taxes paid in US, just like TDS. So when TDS is deducted, what you do is generally you allow the against the tax payable, you allow the TDS credit, and the balance part is the self-assessment tax which you compute. Similar way, India will allow the credit for the taxes paid in US. Clear? In other situation, say for example, if there was a non-resident, if say for example, I am a non-resident and I am a resident of USA. Now I am having some rental income from India. In that particular case, India will say it is income deemed to accrue or arise in India as it is from source in India. And India will charge the tax on that. USA will be my resident country, and it will also say that, look, this is chargeable to tax in USA. Why? Because you are a resident of USA, and as per US laws, the global income of resident is chargeable to tax in US. Now, what India and USA under DTAA will do is, USA will say, India, you can only tax this much, and whatever you will tax, I will allow the credit of that. Clear? Also, from India's perspective, in the case of non-resident, as I said while I was teaching you 195, the tax rate which India will deduct tax on will be the rate under the Income Tax Act or the rate under the DTAA, whichever is beneficial. So at what rate India will deduct TDS on the payments being made from India? At the rate under the Act or the rate under the DTAA, whichever is beneficial. So this is provided by section 90 itself. The rate under the Act or the rate under the DTAA, whichever is more beneficial, will be provided to the assessee who is a non-resident while deducting the TDS on that particular payment. Clear? So this is the basic about like why and what are exactly this DTAAs. Clear? Any doubt? Any doubt? So what are the objectives of DTAA? It grants the relief from double taxation. It avoids the double taxation. Also, DTAA helps in exchanging the information of exchanging information about the resident of one country to another country. Why? Because say there could be a possibility that I may be hiding my income in India. So the income earned from USA, I would be hiding in India. I would not be declaring in the income tax return. So in that case, what USA will do is it will exchange the information with India that this is your resident and he has earned this or this income. So that will facilitate the reporting of correct income and prevent the evasion of taxes. Clear? DTAA also help in recovering the taxes. So say for example, if I have defaulted in payment of taxes in India and I am say a non-resident, then if I'm a resident of US, India can request US that please recover it on our behalf and give us the money. So DTAA facilitates these kind of objectives. Is it clear? Is it clear? Any doubts? Any doubts? Preeti and Anjali, did you understand 10% will apply? Venkateshan, 10% would apply for redemption of GDR. Okay. So, as I said, section 90 provides the provision of Act or DTAA, whichever is more beneficial shall prevail. But for claiming the benefit under DTAA, a non-resident is required to furnish tax residency certificate and form 10F. Now, what is that? Remember this very clearly because this could be asked for objective or small question. What is form 10F and tax residency certificate? So say for example, I am a non-resident in India and I am resident of USA. Now, if I want that the tax rate which should apply should be under the act or the treaty, whichever is beneficial. Now the treaty rate can only apply when I will show to India as a source country. India as a source country. When I will show to India that look, I am a resident of USA. I am a resident of USA and hence I am eligible to claim the benefit under India-US tax treaty. I am eligible to claim benefit under India-US tax treaty. So how will I show to India that I am resident of US? By producing a certificate which will have mentioned that I am a resident of USA. This will be issued by the US government that this and this person is my resident and this should be allowed the treaty benefit. Clear? So why this particular has been introduced provision? So that the treaty is not misused by person who are not the genuine resident of that country. Clear? Is it clear? So there are two countries. One would be always a resident country where a particular person is resident, and the another would be source country where the income is getting accrued or arising or received. Clear? So DTAA will apply in that particular case to avoid double taxation, and to claim the DTAA benefit, I will need to show that I am resident of one country. Is it clear? Any doubts? Any doubts? Sandeep, US has several states. No, we need not see country wise. It is just USA as a whole whose tax treaty is there with India. Any other doubt? Okay. Now, what is this exactly the concept of double taxation? Let's understand it through a chart. So there are two kinds of double taxation. One is juridical double taxation and another is economic double taxation. Now, what is juridical double taxation? Wherein a resident of a country is taxed in another country due to source of income in that another country. So this means same person taxed in two countries. Clear? Same person is taxed in two countries. A resident of country is taxed in another country due to source of income in that another country. So one person is getting taxed in two countries. That is juridical double taxation. What is economic double taxation? When same income. So in the first case, I was talking about same person. Here I am talking about same income. When same income is taxed in hands of more than one person in different capacity. What do we mean by that? So now dividends are taxable in the hands of shareholder, right? But earlier dividends were not taxable in the hands of shareholder, it was exempt in the hands of shareholder, and DDT was levied on the company, right? Or say for example, now also if you consider, company pays corporate tax on its profits, right? Company pays corporate tax on its profits. Then on the same profits which will be distributed, shareholder will pay the taxes. So same income, it's the same profits which are coming. First company is paying corporate tax and then the shareholders are paying the taxes on dividend, right? So it is on the same income, the taxes are levied at 2 points in time, right? Earlier also when there was DDT, company only was paying the corporate taxes as well as DDT. Company only was paying the corporate taxes as well as DDT. But DDT was just a collection mechanism because it was ultimately a tax on shareholders on. So in that case, this is known as economic double taxation, when same income is taxed in the hands of more than one person in different capacities. Clear? Now, juridical double taxation is addressed by DTAA and section 91 also. However, this is not addressed by DTAA. Economic double taxation is generally not addressed by DTAA. Only juridical double taxation is addressed by DTAA. How DTAA addresses juridical double taxation? In two ways. First, by allocation of taxing rights, and second, through double tax relief. Now, what do we mean by allocation of taxing right? As I said, India and USA will come together and mutually decide how much each country can tax. How much each country can tax. So usually a resident country will always have the first right to tax. The right of the resident country will always be the primary right, usually. The source state where the income is getting accrued, that country will have only a minimum right. That country will only have a minimum right to tax, and that is decided mutually by two countries. So they come together and negotiate based on their bargaining power as to how much right is to be granted to the source country. So that is one mechanism to eliminate double taxation. So what will happen is, India, if it is a source country, it can only tax up to the rate provided under DTAA. It can tax as per the rate under the Act or the rate under the DTAA, whichever is lower, whichever is more beneficial to assess. Right? So in that way, double taxation is curtailed because India is given only limited power to tax as a source country, or US will be given a limited power to tax as a source country. Second, the resident country will have to grant the double tax relief of the taxes paid in source country. Clear? So a resident state will always have the primary right to tax, but it will have to provide the credit of taxes paid in source country. Is it clear? Is it clear? So usually how the double tax relief will be granted? How the double tax relief is granted? Two ways. Bilateral relief, unilateral relief. Now, what is bilateral relief? When DTAA exists. So, if the agreement exists between the two countries, the relief is provided bilaterally. Bilaterally as in, India will also provide the credit when India is a resident country. So, India will provide the credit to its resident on income accruing in USA. And USA will also provide the credit of taxes paid in India to its resident on income accruing in India. So there is a bilateral relief. What is unilateral relief? When no DTAA exists. So say for example, there is no DTAA with say Cayman Islands. In that case, India will grant the credit of taxes on income generated in Cayman Islands, but we do not know whether Cayman Island will do in the opposite situation. So that is a unilateral relief. India provides unilaterally under its Income Tax Act. This is provided under Section 91. This is provided under Section 91. So India grants credit of taxes paid in source country unilaterally. Clear? It grants the credit of taxes paid in source country unilaterally. Now, bilateral relief is again of two types. Bilateral relief is again of two types. Exemption method credit method. Exemption method and credit method. Clear? Under the credit method, what they do is they grant the credit of taxes paid in other country. Under the exemption method also, there are two methods. One is full exemption method and second is exemption with progression method. Now, what is this? Full exemption meaning what? What do we mean by full exemption method? So, under full exemption method, what India will do is it will exempt income of its resident. It will exempt the income of its resident, which is taxed in source state. Right, which is taxed in source state. What it will do is, so say for example, there are dividends received from say USA, and if India follows exemption method, it will exempt the entire dividends received from USA. It will not tax it. It will not tax it. So if income is received from USA, say dividend income on shares of some US company, India will not tax it if it is following exemption method. Under exemption with progression method, India will exempt the income taxed in USA, taxed in say source country, I'm not writing USA, taxed in source country, but will include it for determining tax rate. So what does this mean? It will include it for determining tax rate. Meaning here is that India will say exempt the dividend which is received from US company, but for determining the slab, applicable to a non-resident, applicable to a resident individual. So if say for example, I am an Indian resident, I am receiving dividend from US shares. Now, India will not include that particular income in my total income. But just for determining the slab rate as to where if I am falling under 2,50,000 or I am falling under 2,50,000 to 5 lakh, for determining that, India will just include for determining the slab rate. That's it. It will not include in the total income. But for determining under which slab I am falling, it will include it. Is it clear? So this is something like you do it under agriculture income. So you have the exemption for agriculture income, but what you do is for determining the slab rate, you include it. Clear? So this is something like that. And under the credit method, what we do is India will grant credit of taxes paid in source country against its own tax liability. This is just like TDS. So generally India follows credit method. Generally in 99% cases India follows credit method. Clear? Now, how the credit is to be computed? We'll see. That is provided under section 90. Read with rule 128 for bilateral relief. For unilateral relief, it is under section 91. Read with rule 128. Clear? But any doubts till now? Any doubts? Are you understanding this concept? We'll solve few sums on this also. So how credit is to be computed? Rule 128 talks about computing the credit. Rule 128 talks about that. So foreign tax credit, country for which it is available. So it will be available with which India does not have a DTAA as well as with which India has the DTAA. Clear? It will be available in respect of both. With which India has the DTAA as well as with any other country with which India does not have a DTAA, because India also grants unilateral relief as well as bilateral relief. Who can claim the foreign tax credit? Only a resident of India can claim the foreign tax credit in respect of the taxes which have been paid in the other country. Clear? So if you offer the corresponding income to tax, you will get the credit of the taxes paid in other country. Against what you can claim foreign tax credit? Only against income tax, surcharge and cess. You cannot claim foreign tax credit against interest and penalty. So say for example, I'm paying some interest income in USA for non-filing of my return in USA. I cannot claim that interest income against interest paid against the taxes offered in India. Or I cannot set it off the interest paid in India against the interest paid in USA. Clear? So I can only claim the credit of income tax and surcharge and cess paid in the other country. Say for example, if in USA, I am disputing that this should not have been my tax. My tax should have been say rupees 100. USA is saying your tax should have been rupees 150. So in that case, I cannot be allowed the credit of 150 or 100, and it will only be allowed in the year of settlement of dispute. So when I will settle the dispute and I will offer that income to tax, only in that year I will be allowed the credit. Or say for example, I am saying in US this income should not have been taxable at all. Then in that case, it will be offered to tax only in the year of settlement of dispute. Clear? How will you compute the credit? Credit will be computed for each source of income on the lower of tax payable under the Act or the tax paid in foreign country, whichever is lower. So the tax rate will be determined, the tax rate under the Income Tax Act or the tax paid under the foreign country, whichever is lower, will be granted as the credit against Indian Income Tax Act. Clear? How the credit will be determined? What will be the conversion rate for converting the foreign taxes? It will be the telegraphic transfer buying rate as on the last day of the month, immediately preceding the month in which such tax has been paid or deducted. Meaning that if the tax is paid in say June, then the telegraphic transfer buying rate of the 31st May would be used for determining or for converting the foreign taxes which have been paid in that country. Clear? Is it clear? Any doubt? Any doubt with respect to this? Ambika, I'll again repeat the difference between bilateral and unilateral. Any other doubt? Kunal, okay, I'll repeat full exemption method. Any other doubt? Also, remember that you need to provide to the income tax authorities in Form 67 the details of the foreign income and the taxes paid. So you have to furnish certain documents. You have to furnish the documents with regard to how much taxes you have paid. You have to furnish the tax deducted certificate of that country or the self-assessment tax challan paid in that country to claim the foreign tax credit in India. Clear? Kunal, full exemption method means that if, say, for example, I have earned some dividend on US shares, then India will not include it only in the total income. India will not include it in total income and it will be exempted completely. But exemption with progression means that India will not include it in total income, but just for the purpose of determining the slab rate, it will include it. As in, to determine under which slab I am falling, to determine the slab. So say, for example, if income is 1 lakh, right? And I have other income of 1 lakh or 1 lakh 50. So if I have other income in India of 1 lakh 50, just let's take an example for that. So to make you understand better. So say, Kunal, I have income in India, say interest income, 1 lakh 50. I have, say, income from US, 1 lakh. Now this 1 lakh would be exempt. This 1 lakh, say, would be exempt. But for determining the slab rate, under which slab I am falling, or say I will take it as 1.10 lakh to tell you more better way. So for determining the slab rate, I will just include it. So because then I'm crossing that 2 lakh 50 limit and then I will have to pay the tax at the rate of 5%. Are you understanding? So this will not be taxed in India. This will be exempt under exemption with progression method. But for determining the tax rate on this 1.5 lakh, I will take into consideration 1.10 lakh. So though I will exempt 1.10 lakh, but for determining the tax rate on 1.5 lakh, under which slab I am falling, I will take into consideration both of this. I will take into consideration both of this, and this will be 2.65 lakh, which is crossing the 2.50 lakh income tax slab which we have, and therefore on 1.5 lakh, 5% tax will be payable. So it's not that if this exemption method was followed, then no tax would have been paid in India, even on 1.5 lakh. Because what would have happened? I would have fallen below the basic exemption limit because this becomes exempt. But if exemption with progression method is followed, then in that case, I will pay 5% tax on 1.5 lakh only. 1.10 lakh would still remain exempt, but I am determining the tax rate. For determining the tax rate, I will include both of it. Clear, Kunal? Is it clear? The difference between bilateral and unilateral, Ambika, under bilateral, what will happen is, I am resident of India. I am paying taxes in US on US sourced income. I will get the credit in India. Similarly, a US resident will get credit in US on income sourced in India. So they bilaterally have this agreement. Under unilateral, only there is no agreement. Therefore, only India unilaterally grants the credit because there is no agreement existing. Clear, Ambika? Sandeep, telegraphic transfer buying rate is to be used because the taxes would have been paid in US dollar, right? Taxes would have been paid in US dollar. So if taxes have been paid in US dollar, to convert that income, I need some foreign exchange rate. So I will use telegraphic transfer buying rate as on the last date of the previous month in which the taxes have been paid. So if taxes have been paid in the month of June, I will take the telegraphic transfer buying rate of 31st May. Clear? For converting the foreign taxes. Is it clear? Clear, Sandeep? So, if you see, for converting foreign taxes, you use TTBR as on last date of previous month in which taxes are paid. Previous month to which taxes are paid. Clear? For converting the income, this is for converting the taxes, right? For converting the income, Rule 115 provides for exchange rate for conversion of income in foreign currency to INR. And what are the rates? For salary, you have to take TTBR as on last date of month preceding the month in which salary is due or paid in advance or in arrears. For salary. For interest on securities, same. TTBR as on the last day of the month preceding the month in which interest is due. For income from house property, PGBP, IFOS, other than dividend, TTBR as on the last day of previous year. So for all you have to take TTBR only. TTBR as on the last day of previous year. For PGBP, in case of non-resident engaged in business of operation of ships, again last date of month preceding the month in which income is deemed to accrue or arise. In India. For dividend, again last day of the month preceding the month in which dividend is declared, distributed or paid. And for capital gain, again same, last day of the month immediately preceding the month in which capital asset is transferred. So if you see, it's always the last day of the month immediately preceding month in which the event is happening, except in the case of IFHP, PGBP and EFOS, where you have to take the last year of previous year. This is for converting the foreign exchange income, the income which you are receiving in foreign exchange. For taxes, you have to take the last year of the previous month in which the taxes have been paid. Clear? Any doubts? Aman, for what you are asking, which method to follow? Are you understanding all this concept? We'll solve the sums on this. Are you getting this? Any doubts? So if you do not have any doubts, we can take a 10-minute quick break and then we can, solve the sums on this DTAA part. So we quickly take a short break and then we get back. Okay, so let's start with the questions now. Ambika, you had doubt that in section 91 also credit method is used. Yes, Ambika, under section 91 as well as section 90, as I said, India most of the time follows only credit method. 99% of the DTAAs, India has credit method. Okay, so let's quickly start with solving the questions based on this. We'll solve one sum together and then I'll give you few sums to solve it on your own. Let me share the screen. Yep. So Nandita, an individual resident, retired employee of Prasar Bharati, age 60 years, is a well-known dramatist deriving income of rupees 1,10,000 from theatrical works played abroad. Tax of 11,000 was deducted in the country where the plays were performed. India does not have DTAA under section 90, meaning unilateral relief will be allowed under section 91 because there is no DTAA with that country. Her income in India amounted to 6,10,000. In view of tax planning, she has deposited 1,50,000 in PPF and made contribution to approved pension fund of LIC 32,000. She also contributed 28,000 to central government health scheme during the previous year and gave payment of medical insurance premium of 26,000 to ensure the health of her father, a non-resident aged 84 years, who is not dependent on her. Compute the tax liability of Nandita for the AY 2021. So how we will do it in this case? Let's see. Let's solve it together, this one sum. So what is her income in India? Income in India is how much? 6,10,000, right? Her foreign income is how much? Her foreign income is 1,10,000. So gross total income is 7,20,000. Less chapter 6A deductions, right? Section 80C. Section 80C. What are the deductions under section 80C? She has contributed 1,50,000 in PPF and contribution to approved pension fund of LIC is 32,000, right? So in that case, PPF 1,50,000 and next is contribution to 32,000 to pension fund of LIC. Pension fund 32,000, right? But how much deduction will be allowed is 1,50,000. 1,50,000 will be eventually allowed. This is under 80C and this will be under 80CCC, right? This will be first one is under 80C and the second one is under 80CCC. But the total deduction will be restricted to 1 lakh. Restricted to 1,50,000 as per 80CCE, right? Clear? Next, deduction under section 80D. Deduction under section 80D. What was that? Let's see. She has contributed 28,000 to central government health scheme during the previous year and gave medical insurance premium 26,000 to ensure the health of her father. So 28,000 is paid for her. And how much is the maximum allowed? She's a retired employee age 60 years. So she is herself a senior citizen, right? And what is the limit under 80D? It is 50,000, right? It is 50,000. So for her, it will be Entire 28,000 allowed. Contribution to central government health scheme. 28,000, right? Because it is allowed up to 50,000 to senior citizen, right? How about contribution for her father? How much will be allowed? It is mentioned she has contributed 26,000 for her father, who is a non-resident aged 84 years. So even for her father, will 50,000 will allowed? The answer is no, because her father is though a senior citizen but is a non-resident. So this higher amount of 50,000 is allowed only in case of a resident senior citizen. So her father will only be allowed 25,000. Her father will only be allowed 25,000 and not the entire amount of 26,000, because the higher deduction of 50,000 is available only in case of resident senior citizen. Clear? So in this case, how much will be the deduction which will be allowed? 1,50,000, 28,000 and 25,000. So total deduction which will be granted to this assessee is 2,03,000. 2,03,000. Clear? Two lakh 3,000. Right? So what will be the total income in this case? Total income which will be taxable in this particular case would be how much? 5,17,000. 5,17,000. And now tax on this amount will be first computed. Tax on rupees 5,17,000 would be how much? How much is the tax liability they have given? 13,936 including the cess. 13,936 including the cess. Now you will allow the credit under section 91 for foreign taxes paid. For foreign taxes paid. Clear? In this case, how much will be the credit? You will have to determine the tax rate in India. Tax rate in India, which will be 13,936 divided by 5,17,000 into 100. Right? The tax rate in India will be the total taxes paid here divided by the total income, and that amounts to 2.696%. 2.696%. Right? 2.696%. Then tax rate in foreign country. Tax rate in foreign country was how much? How much taxes were paid in the foreign country? 1,10,000 was the income and 11,000 was tax deducted. So it is 10%. Right? 10% of the taxes were paid in the foreign country. Now it comes to 10%. So lower of this, lower of 2 comes to 2.696%. Therefore, foreign tax credit under section 91 will be equal to 1,10,000 into 2.696%. That will be your foreign tax credit. What is that amount? What is that amount? 2,966. 2,966, right? 2,966. And therefore, total tax payable in India, total tax payable in India is 13,936 minus 2,966, which comes to how much? 10,970. Are you clear how we have to solve these sums? So you have to determine the beneficial tax rate of the rate under the foreign country or the tax rate in India. Whichever is lower will be allowed as credit against the taxes paid in India on that foreign income. Is it clear? Did you get this sum? Any doubts? Did you get this question properly? Any doubts you have with respect to this question? Any doubts? Then I can give you the other question if you do not have any doubts and I want you to solve that. Any doubts? So questions will be asked like this only in examination on this DTAA aspect mostly. Any doubts? Okay. Let's move further. Then I'll give you the question to solve if you do not have any doubts, and let's see if you are able to answer. I'm sharing the screen. So this is the question. Amruta is a resident individual. She has income from the following sources. Taxable income from sole proprietary concern in Kochi, 50 lakh. Share of profit from a partnership firm in Chennai. Agricultural income from rubber estate in country A, with which India has no DTAA. USD 70,000, withholding tax 10,500. They have given already the USD conversion rate, so you do not have to worry about TPBR. Brought forward business loss in country A, which is not permitted to be set off against the other income as per laws of that country. Compute the taxable income and tax payable by Amruta. So, giving you 4 minutes time, tell me what will be the answer in this particular case. Pooja, even though tax paid in foreign country is more, we get less credit. The reason for that is, see, if the taxes are paid in foreign country, right, and that foreign country tax rate exceeds my income tax liability, right? Because in a way, what is the logic behind that is that India is charging tax effectively at the rate of 2.696%. Correct? Now, if India allows a credit of 10%, in that case, India is effectively allowing to reduce its income tax liability, which is due against other income also. Are you understanding? Which is not taxed in foreign country. Effectively, if there was no other tax also, so no other income also in India, India will have to refund the taxes paid in foreign country. What will happen in that case is everybody will come and obtain the refund, and the other country will deliberately levy higher taxes. In that case, India's income tax base would get lower and lower if India start giving refund of the taxes paid in other country. That is not allowed. Always the taxes amount, credit amount will be restricted to the tax liability in India. India is not liable to grant the refund of taxes paid in other country. Right? In that way, if India start issuing the refund, then our tax base will get lower and lower. Are you understanding, Pooja? Aman, you had the same doubt. Are you clear? So it will be always restricted to the lower of that. Right? In the case of credit, it will always be restricted to what my tax liabilities. Otherwise, what will happen? My taxable portion will get reduced and reduced. If India start giving refunds of the taxes, it will allow the higher credit more than its own effective tax liability. In that case, it will be harm to the Indian taxable base. Clear? Clear, Pooja and Aman? What is the answer for this question? No, Ambika. Your credit amount is right, Ambika. But not the tax on total income. No, Gomathi. Pooja, are you clear with the doubt? Aman? Okay, let's solve it together. So in this particular case, if you see, they have given us the information that Amruta is a resident individual and she has the following sources of income. Let me open up that question again. One second. Yes. Taxable income from sole proprietary concern in Kochi. Now, first is profit and gains from business or profession. Income from sole proprietary concern in India, 50 lakhs. Right? Next, share of profit from a partnership firm. Share of profit from partnership firm is exempt. Right? This is as per under section 10(2)(a). Clear? Then agricultural income from rubber estate in country A with which no DTAA with India, 70,000 US dollar. So this I am putting it under income from other sources. Agriculture income, 70,000 into 64 US dollar, right? This comes to approximately how much? 44,80,000. 44,80,000. Right? Brought forward business loss in country A was USD 10,000, which is not permitted to be set off against other income as per the laws of that country. No, it is not allowed in the laws of that country, but it is allowed under my laws, right? We allow the brought forward business loss to be set off. So I will allow it because I am resident of which country? India. And I will follow Indian laws. So though the source country does not allow it, but I being a resident country, I will allow the set off of loss. So less brought forward business loss in country A, 10,000 into 64, right? This will be 6,40,000. Clear? So this will be 43,60,000 and plus 44,80,000. So my gross total income will be 88,40,000. Clear? 88,40,000. Now, I will have to compute tax on total income. Tax on total income, it will be as per the slab rate. It comes to how much? 24,64,500. 24,64,500. Add surcharge at the rate of 10%. Add surcharge at the rate of 10% since the income exceeds 50 lakhs. Right? You will have to add surcharge. 2,46,450. 27,10,950. Add cess at the rate of 4%. 1,08,438. Total tax 28,19,388. Clear? Now I will have to compute the foreign tax credit. Now I will have to compute the foreign tax credit. Again, this will be under section 91. Right? So what will be the foreign tax credit? average rate of tax in India. How much? 28,19,388 divided by what was the total income? 88,40,000 into 100 is equal to how much? 31.89%. 31.89%. Average rate of tax in foreign country, country A. 10,500 they have given is a tax on agricultural income divided by 70,000 into 100, right? 15%. Lower of this is 15%, right? In that case, what you will do is 1 lakh. How much was 70,000 into 64 into how much? 15%. This will be allowed as the foreign tax credit. Are you clear? This will be allowed as the foreign tax credit. Is it clear? This will be allowed as the foreign tax credit. Are you getting this? So what we have to do is we have to compare the average rate of tax, right? After computing the average rate of tax, what you have to do? You will have to determine which one is lower, whether the average rate of tax in India or the average rate of tax in the foreign country is lower. Is it clear? But again, here one thing, here we have the loss also. Here we have the business loss also, if you see, right? If you have the business loss, then in that particular case, here it should not be actually 70,000. Here it should be 70,000 minus 10,000. So here ideally it should not be 70,000. Here it should be 60,000. Why? Because the doubly taxed income, the double taxed income is not 70,000. I am allowing the set off of loss also. Though it is not allowed in that country, but I am allowing it. In my country, it is allowed. So I will be only giving the relief against 60,000. So 60,000 into 64 into 15%, it comes to 38,40,000. 38,40,000. Is it clear? That will be the doubly taxed income. And how much is the tax on this? Tax on this as 15% is 5,76,000. 5,76,000. So this is my credit which will be allowed, and the total taxes paid. Total tax payable is 22,43,390. Clear? So here I will not allow the relief on 70,000 because I am also allowing the set off of losses. Clear? And therefore it will be 5,76,000. Is it clear? Any doubt? Gomati, agricultural income is not exempt in India. It is exempt in India. It is not exempt outside India. Are you clear, Gomati? Agricultural income is exempt in India if it is Indian agricultural income. Clear, Gomati? Any doubt with respect to this sum? Should we solve one more sum? Any doubts with this sum? Did you understand this sum? Let's solve one more sum on this. And again, you will have to tell me the answer for that. So Kalpesh, aged 56 years, a resident individual, furnishes the following particulars of income earned by him in India and country T. India has not entered into DTAA with country T. Income from profession carried on in India 6 lakh. Agricultural income in country T 75,000. Dividend income in country T 1 lakh 20. Royalty income 4 lakh. Expenses incurred for earning royalty 60,000. Business loss in country T 75,000. As per income tax law of country T, business loss is not eligible for set off against any other income. The rate of income tax in country T is 20%. Compute the total income and tax payable by Kalpesh. So you tell me at least the total income computation first and the tax payable, then you can compute. Amman, if business laws belong to India, then 70,000 would have been taken. Perfect. Not 60,000 because business laws is belonging to that country. We are adjusting it. Yes, total income is correct, but that is gross total income, Gomathi. What is the net total income? There's a one specific deduction here, which you have to apply. Also, how much would be the foreign tax credit, Gomathi? In this case, remember one thing. You will have one deduction to be taken. And that is deduction under section 80QQB, which is on royalty income of a resident. Which is on royalty income of a resident, which is equivalent to 3 lakh rupees. You have to take into account that deduction under section 80QQB before coming to net total income. Ambika, total income is not 10 lakh 60. As I said, you will have to take into account 80QQB deduction on royalty income, which is earned in a convertible foreign exchange. So you have to assume that this is in convertible foreign exchange and you get that deduction. What will be the foreign tax credit here? So I'll start solving the sum till the time you give me the amount of foreign tax credit. So Kalpesh, aged 56 years, income has furnished the following incomes. Income from profession carried on in India. So first is under PGBP. Income from profession in India. How much that is? 6 lakh. 1 second. How much that is? 6 lakh. It is coming to 6 lakh, right? Second. Next source of income they have given is agricultural income in country T. So again I am putting it in the IFOS. Agri income. How much they have given? 75,000. Then dividend income from a company incorporated under country T, 1,20,000. Right? Royalty income from a literary book. Royalty income from a literary book from country T, 4 lakh. A royalty, 4 lakh. Expenses incurred for earning royalty, 60,000. Expenses incurred for earning royalty. Why I am allowing here deduction of expenditure? Why I am not taking it on a gross basis at the rate of 10% under 115A? Any reason? Why I am taking the royalty on net basis and not the gross basis? What do you think is the reason? Any reason for that? Why I am taking the royalty on net basis and not the gross basis? Any reason? Yesterday only we had studied royalty at the rate of 10% on gross basis. Then why I am doing that? Because that was for non-resident. So if a non-resident has income from royalty accruing in India or deemed to accrue in India, that will be at the rate of 10%. Here I am talking about resident. And for resident, global income is liable to be taxed at the normal rates. Clear? So even if he is earning income from outside India, that will be at the normal rate of tax. Clear? And in that case, there will not be any special rate and therefore it is on net basis. Clear? So 4 lakh minus 60,000, 3 lakh 40,000. Are you clear why I am taking it on net basis? Because for gross basis, it was for resident. It was special rate. It was for non-resident. That special rate of tax under 115A is for non-resident. For resident, it is normally taxable after taking it on net basis at the slab rate. Clear? Is it clear? And what other information has been given? Business loss in country T, 75,000. So I will set off business loss 75,000. Right? This comes to 5,25,000 and this comes to 5,35,000. So total in GTI would be how much? 10,60,000. Clear? Now you will get here one deduction. Deduction under section 80 QQB. Royalty income of a resident from literary work assumed to be received in convertible foreign exchange. Clear? 3 lakh. So total income in this case would be 7,60,000. Clear? What will be the tax on total income? 64,500 plus cess at the rate of 4%. Cess at the rate of 4%, 2580, 67,080. Clear? 67,080. Now calculation of rebate under section 91 because there is no DTAA. Average rate of tax in India is how much? 67,080 divided by 7,60,000 into 100, 8.826%. Right? Average rate of tax in country T. In country T. Now what is the rate here given? Average rate, the rate of income tax in country T is 20%. They have clearly given it as 20%. So we need not determine anything else, right? So lower of this 8.826%, right? Now this will be on the doubly taxed income. Now what is doubly taxed income here? Agricultural income 75,000. Then dividend income 1,20,000. Royalty income, this will be 4 lakh minus 60,000 and minus 3 lakh. Why I am reducing 3 lakh? Because I am allowing a deduction of rupees 3 lakh under 80 QQB, and therefore to that extent of 3 lakh it is not doubly taxed. Since India is allowing a deduction, it is not taxing it. So then it does not become a doubly taxed income. What is a doubly taxed income? Where India is also taxing and other country T is also taxing. But in this case, I am not taxing that 3 lakh because I am granting a deduction. So on what amount I am taxing is 4 lakh minus 60,000 minus 3 lakh. Clear? So in that case, the doubly taxed income would be here in this scenario only 40,000. Clear? Only 40,000. Less business loss 75,000. Right? Less business loss 75,000. So what will be the doubly taxed income? 1,60,000. Clear? and rebate under section 91 will be 1,60,000 into 8.826%, which comes to 14,122. Clear? And therefore total tax payable is equal to how much? 67,080 minus 14,122, 52,960. Clear? Any doubts? Did you get this sum properly? Ambika, did you get it? How the foreign tax credit is computed? Dhanush, your answer was perfect. Everyone got this question? Any doubts with respect to this? Any doubts? Aman, dividend is taxed because dividend from foreign country is taxable. Even now from India it is taxable. Clear, Aman? All of you got this question very clearly. Let's do one more question, but it's not of computation. It's mainly of logic, like how you give the rebate. Again, a past exam question. Mr. Manav, a resident, has derived certain income from nation Q, with which no DTAA exists. So again, unilateral relief under section 91. In country Q, any income chargeable to tax is charged at the flat rate of 18%. Okay. Mr. Manav has derived the following income from Q. Agricultural income from land in Q, 14 lakh. Share income from a partnership firm in Q, 18 lakh. In nation Q, agricultural income is exempt and does not form part of total income. State with reasons whether Mr. Manav can claim double tax relief in respect of the above two item of income and also determine the quantum of double tax relief. The Indian rate of tax may be taken as 20%. So what would be the answer in this case according to you? What will be the double tax relief? Give me the answers. What will be the answer in this scenario? What will be the double tax relief? How, Dhanush, taxable income will be this much? How, Pooja, 5,76,000? What is 5,76,000? 18% you computed on what? Very nice, Ambika. Yes, right, Gomati. Perfect. So in this case, understand one thing. First of all, agricultural income from land in Q, 14 lakh, that is in this case not taxed in country Q. In the last examples which we discussed, in that case, agricultural income were taxed in the other country also. Right? India taxes agricultural income from foreign country. If it is from India, then India exempts agricultural income. But if it is from foreign country, then India taxes it. India will still tax agricultural income. But India will not grant relief against agricultural income. Reason being, it is exempt in foreign country and therefore it is not doubly taxed. Therefore, it is not doubly taxed. Right? So in this particular case, agricultural income would be taxed in India, but no relief will be allowed because no taxes have been paid in other country on agricultural income. In the earlier examples, taxes were paid in other country on agricultural income. In this case, the other country exempts it. So therefore, no DTAA relief will be no double tax relief will be granted under 91. Why? Because this is not a doubly taxed income. What about share income from a partnership firm in Q? 18 lakhs. Now there are 2 points of view. There are 2 interpretations of this provision of section 10(2)(a). One interpretation could be that even in this case, India will exempt the share income from a partnership firm and therefore this will not be doubly taxed income, right? India will exempt it. So though it is taxed in country Q, India will exempt because under section 10(2)(a), income from partnership is exempt. So no credit will be allowed. Other point of view is under section 10(2)(a), income from partnership only incorporated as per Partnership Act is exempt and not the foreign partnership. Then in that case, if that perspective is taken, then the credit will be allowed of 18% only against 18 lakhs. That will be 3,24,000. So it will not be allowed against agricultural income, but only against partnership firm. Why? Because the other view is that under section 10(2)(a), exemption is allowed only in respect of profits of Indian incorporated partnership firm. Partnership firm incorporated as per the Indian Partnership Act. Is it clear? Any doubt? Yes, Ambika, the tax credit is right. Aman, your answer was also correct because as I said, there are 2 points of view. Is it clear? No doubts? Okay. Now, the last 2 concepts of double tax relief, I am taking it up. One is the PE concept. I discussed with you in the last classes about PE. I told you that point in time you understand PE as a branch of a foreign company. Now I'll discuss with you what is exactly a permanent establishment. So permanent establishment means it is a presence of the foreign company in India. Presence of a foreign company in India through a fixed place of business. Through a fixed place of business through which the foreign company carries on the business in India. Permanent establishment means a fixed place of business. Now, this fixed place of business could be through a branch, could be through an office, right? Therefore, if the business is carried on that through fixed place of business, that constitutes a permanent establishment. Why it is called permanent establishment? Because there is an office through which the business has been conducted for quite a lot of time. And if there is a PE constituted, then the DTAA says that, so we have the concept of business connection, which was under the Act. For DTAA, we do not have the concept of business connection, we have the concept of PE, right? PE means a fixed place of business through which business of an enterprise is wholly or partly carried on. Now, once you have a PE, then in that case, what will happen is the profits attributable to PE are taxed in India. Similarly, you remember under section 911, I said only the profit attributable to operations carried out in India will be taxable when business connection is constituted. Similarly, under DTAA, when a PE is constituted, only the profits attributable to PE will be taxable in India. Is it clear? Under business connection, if you remember, we had done an agent can constitute a business connection. Similarly, under PE also we have that system that if there is an agent who concludes the contract or who does not conclude but has the principally done all the terms of the contract, who negotiates the prices, who secures the contract, who stocks the goods and delivers the goods therefrom, and therefore that kind of dependent agent would constitute a PE. That kind of dependent agent would constitute a PE. Now you will ask why there are two terms. We have a PE, we have a business connection. Why there are two terms in place? So Act uses the term business connection. And as I had said, business connection is a very wide term. It is not clearly defined. It only says what it includes. DTAA has a clearly defined definition of permanent establishment. Therefore, as I had said, the provision of Act or DTAA, whichever is beneficial, will always apply. And then in that case, the provision of PE, since they are very narrow in concept, they are clearly defined. Therefore, if there is a DTAA between country, then the term PE will apply for taxing the business profits. For taxing the business profits, the term PE will apply and not business connection if there is a DTAA. When there is no DTAA, business connection only will apply. But when there is DTAA, the term PE will apply. Is it clear? Because it's a very defined concept. It's a very narrow concept. And when the business profits are to be taxed, we have to see whether the PE exists in India or not. So it's a very similar concept to business connection, but business connection is very, very wide. Whereas PE is a very defined term. Is it clear? And if there is no PE in India, if a foreign company does not have any permanent establishment in India, say it does not have any branch in India, then in that case, though there could be a business connection. If say for example, a foreign company is selling goods in India, there could be a business connection constituted. But a PE is not constituted because there is no branch in India. And then in that case, the income will not be taxable in India. If there is no PE, no income will be taxed in India. Clear? Is it clear? Any doubt? Aman, I told you the answer. How we have to write? I told you it was on 18 lakh. You have to compute 18% and that will be the rebate. Or you can write both of the incomes are exempt. Agricultural income is exempt in country T and therefore it is not a doubly taxed income. Hence no relief will be allowed. It will be taxed in India at the rate of 20% but no relief will be allowed under 91. Whereas for partnership form you can write it is exempt under 10(2)(a). in India and therefore no relief will be allowed, or you can write it is taxable in India as per 10(2)(a), the other interpretation, and you can compute the rebate at 18 lakh into 18%. Clear? Is it clear? Okay. Then we quickly move to the next concept. Make available concept. Now, what is this make available concept? Again, as I said, the provisions of DTAA, if they are more beneficial, will override the provisions of Act. Now, for taxability of fees for technical services, you saw under section 917, we had a concept of fees for technical service, which were defined as managerial, technical, or consultancy in nature. Right? It was taxable at the rate of 10% under 115A if there was no P. If there is a P, it was taxable at 40%. Now, there is a concept of make available under the DTAA, not under Act. What does that concept say? Some of the DTAA like India, US has this concept which says fees for technical services will only be taxable if the service provider is making available the knowledge to service recipient. What does this mean? Now, I am service provider. I am making you available the knowledge of this international tax. Now, tomorrow, you can go and write the exam even without coming to me and asking again. In that case, it will be taxable as fees for technical service. But say, for example, tomorrow I am not making you available the knowledge. I am just providing you certain information. But when you will have to apply that information, you will have to again come back to me. In that case, it will not be taxable as fees for technical service because I am not making you available the information. What is making available the information? When you can do it on your own next time without coming back to me. If you will have to come back to me, then in that case, I'm not making available the information. And DTAA provides this kind of definition of FTS. So again, this definition is very narrower compared to the definition under Act. So under India US DTAA, if this definition is existing, then the provision of DTAA will apply and not the Act because they are more beneficial to assessee. Clear? Any doubt? Now, how these questions could be asked? These could be asked as a kind of, direct questions in terms of the theoretical questions. These can be asked, not a numerical one. Because of poem, Ambika, what do you mean to say that it is one of the benefit which foreign company can avail because of DTAA even in case of poem? I didn't get your question properly, Ambika. Because when a foreign company has a poem in India, it will become resident and its global income will be liable to tax. Then you can only claim the DTAA benefit with respect to the double tax relief because your global income is liable to be taxed in India. This is only in the case of non-resident whose limited income is liable to be taxed in India. And therefore, what we are determining is whether the non-resident is taxable in India or not. First, I told you about P because for taxability under Act for a non-resident, we have business connection. For taxability of FTS, we have the FTS definition. So these are the restrictive definitions provided under the DTAA, right? So these definition of business connection, FTS were not applicable for resident because for resident, global income is liable to be taxed. These were applicable only for non-resident. Clear? Okay. Then the next concept which is there is in the case of foreign companies. Now, foreign companies have a tax rate of 40%, right? Whereas domestic companies have tax rate of 30%. Right? So there were these questions raised by foreign company. Is it not discriminatory? Because tax treaty generally have a clause of non-discrimination. What does this clause provide? This clause under tax treaty provide that a foreign national will not be treated less favorably or will not be discriminated as compared to the resident of that country. So there is a non-discrimination clause always in every treaty which says that a non-resident or a foreign company will not be discriminated when you compare it with a resident company. So this foreign companies raise the objection that this 40% tax rate is discriminatory because the domestic companies are taxed at a rate of 30%. Right? So India has issued a clarification through an explanation to section 93, which clearly says that the tax in respect of a foreign company at a rate higher than the rate at which domestic company is chargeable shall not be considered as discriminatory. Why that is so? There is a reason to that. Now, foreign companies are taxed at the rate of 40%. Right? Foreign companies are taxed at the rate of 40%. Now, the dividends which foreign company will issue to non-residents, I'm not talking about the Indian resident. Indian residents, global income is liable to tax. Dividends which foreign company usually issue are not taxable in India. Whereas dividends which domestic companies will issue, they will be always taxable in India. So then, any which ways, if you compare Indian corporate tax rate, Indian companies corporate tax rate is 30%. Plus when the dividends are issued, they will be again taxed. Right? So effectively, Indian companies tax rate also becomes 40%, considering the dividend also. Therefore, they say that this is not discriminatory. Clear? So these could be small questions can be asked in examination. Is it clear? Then last one point which I have to teach you in DTAA is the tiebreaker rules. Now, what are these tiebreaker rules? Understand, this is again very important concept. So, say for example, I am resident of India. Now, I will become resident of India if I stay in India for more than 182 days or whatever the criteria we had learned. Now, I am having citizenship of say US. I am having citizenship of US. Now, US will also consider me as their resident. Then in that situation, what will happen is I will become dual resident. I will become dual resident. If I have citizenship of US, I have stayed for 182 days in India, I am becoming resident in both countries. Because as per US tax laws, a citizen is considered to be resident of US. Now, what will happen if I become dual resident? Both the countries will tax my global income. Both the countries will tax my global income. Then in that situation, I will have a much more double taxation happening. Right? So what will be the solution for that? DTAA provides the solution for that. DTAA creates a tiebreaker rules to determine which will be the country, which will be the ultimate resident country. So like in game, we have this tiebreaker, right? Similarly, DTAA gives the tiebreaker as to which country will win and will be the resident country, right? What are these tiebreaker rules? So they say go sequentially. First is place of permanent home. You will have to decide where is your permanent home. Where do you stay? Right? You will have to decide where do you really stay. So though you would have visited number of days in India for more than 180 days, but quite possibly you might be staying with your family in USA. You might have a house in USA. You do not have house in India. You just come and stay here and you visited India and therefore 180 days crossed. So then you have to find out where is your permanent home. Second test, you will have to find out if you cannot find out where is your permanent home, or possibly you may have houses in both India and USA, quite possible. Then you have to find out center of vital interest, meaning where you are earning income from. where you are carrying on the business, where you are pursuing your hobbies, where you are generally staying and performing your activities. That is the center of vital interest, economic and personal interest. If you are doing that in both countries, then you have to look at the third test. Where is your habitual abode? Meaning where you are likely to get settled. In which country you are likely to get settled. In which country your family is living. In which country you have your kids. That is place of habitual abode, where you are likely to go and settle forever. If you cannot find out that also, then the next test is nationality, where you are national of. If you cannot find out that as well, then the government of both the countries will sit together and decide which country is the ultimate resident country of that particular individual. Clear? Any doubts? Did you get these concepts? Any doubts you have? Any questions? So should we proceed further to AAR chapter if you do not have any doubts? Okay. Now I'm quickly moving towards the AAR chapter. That is very small chapter, nothing much in it. What is advance ruling? So the non-resident or resident can go to the tax authority and obtain in advance these rulings from these tax authorities, wherein they will be granted certainty. Like this is the way their transaction would be taxed. This is generally undertaken because there is some new transaction for which there is no judicial precedent. There is no court case in that particular kind of transaction which has been happening. So what the non-resident or resident would generally do is, this is mostly in the case of non-resident, that they go to tax authority and say, these are our facts, and you tell us at the outset what will be our tax liability or how this transaction will be taxable in India. The benefit of this would be that in the future it will not happen that you are given some shock that in future there could be litigation if you do not obtain this advance ruling, because you will do it on your own presumptions, but the tax authorities will not agree on that, right? So therefore, non-residents in case of new transaction generally go for this advance ruling mechanism. Now, who could apply for advance ruling? A non-resident could apply for advance ruling in respect of the transactions which are undertaken or proposed to be undertaken. Both, which you have already undertaken or you are proposing to be undertaken. Second, a resident can also go to AAR in respect of the tax liability of a non-resident. In respect of the tax liability of a non-resident arising out of a transaction which has been undertaken or is proposed to be undertaken by that resident with non-resident. So a resident can also make an application because, as I said, when a resident will make the payments, he will have a TDS liability under 195. If he does not deduct the TDS, he will face disallowances. He will face the consequences of being treated as assessee in default. So to avoid that, a resident can also make an application to determine the tax liability of a non-resident. Clear? A resident can also make an application for his own tax liability in respect of a transaction which is undertaken or proposed to be undertaken, where the tax liability of that transaction would be 100 crores or more. Would be 100 crores or more. A public sector companies can also make an application in respect of an issue relating to computation of total income, which is pending before any income tax authority or the ITAT. Clear? So a public sector company is also an eligible applicant who can make a request to the AR to grant the ruling in respect of the computation of total income, if that question is pending before ITAT or before the any tax authority. Clear? Now, the one important thing is that a decision can also be obtained from AR with respect to the GAR ruling. What is GAR? General Anti-Avoidance Ruling. General Anti-Avoidance Regulation. So, if a transaction which is to be undertaken by any person, whether resident or non-resident, to understand from tax authority whether this is a transaction which is in the nature of, or which seems to be in the nature of, tax avoidance strategy. Because if a transaction is motivated through a tax avoidance strategy, then in that case, GAR provisions usually apply. General Anti-Avoidance Regulation apply. So a resident or non-resident can make an application to determine whether GAR will apply on this particular case or not. Clear? In which cases you cannot go to AR? So you cannot go to AR where a resident applicant has made to an application to an AR. He cannot make it when a decision is pending before the income tax authority or the tribunal. A public sector company can go to AR even if the decision is pending before ITAT or income tax authority. But the resident companies cannot go to AR other than public sector company if a decision is pending or appeal is pending before the income tax authority or appellate tribunal. Clear? So in that case, they cannot pursue both the remedies. Is it clear? Any doubts? Any doubts? Okay. Now, they have given this composition of AR. What will be the composition of AR? So a composition has been changed very recently as to who could be a chairman of AR, who is a judge of High Court or Chief Justice of High Court or a judge of Supreme Court. There could be a vice chairman who is a judge of High Court, a revenue member from IRS. So these are the recent qualifications which they have given up with respect to the members of AR and their tenure. Okay. Then they have also given us the fees which will apply. So these things you will have to remember. This could be asked in theoretical question as to what will be the fees. This could be asked even in the objective question. So where the amount of the transaction is not exceeding 100 crore, then the fee for application would be 2 lakh. Where it is between 100 to 300, it will be 5 lakh. And where it is more than 300 crore, it will be 10 lakhs. Clear? And you will have to submit the application in quadruplicate. Okay, so you will have to submit the application in quadruplicate. Clear? Whatever application you are making, the forms you will have to fill it like that. And then what is the procedure? What kind of questions cannot be raised before AR? One, as I said, if the question is pending before income tax authority or tribunal, except public sector company. The questions with regard to determination of fair market value. So if a question involves determining the fair market value of any property, then that questions cannot be taken up before AR. Transaction designed for avoidance of income tax. As I said, except where the question relates to GAR application, if the transaction is motivated by tax avoidance, then in that case, application cannot be accepted by AR. No application can be accepted by AR. Clear? And on whom the application advance ruling shall be binding? Advance ruling shall be binding on applicant who had sought it in respect of the specific transaction. So you cannot apply the application which has been obtained from AR or the ruling which has been obtained from AR in respect of some other transaction. It is also binding only on the applicant who has obtained it. So it cannot be the case that tomorrow, say for example, my brother is there, he has undertaken the same transaction, what I have taken up. He cannot say that AR, you have given the ruling in her case and my transaction is similar, so it shall be binding on me also. You can of course take a clue from that, but it shall not be binding in your case. It's also binding on the facts which are specific to my transaction. So tomorrow if I'll undertake some other transaction, that AR shall not be binding. It is also binding on the principal commissioner or the commissioner of income tax authorities, and it is not binding on ITAT. So it is only binding on the income tax authorities, the AO. It is not binding on ITAT, CITA, High Court or Supreme Court. Clear? They can disregard the AR ruling. Clear? Is it clear? So this is one chart. Is the applicant an eligible applicant falling under 245 NB? If the answer is yes, you are entitled to make an application. Otherwise, you cannot. Is the application withdrawn by the applicant within 30 days? So you can also withdraw the application within 30 days. And if, say, for example, you do not withdraw within 30 days, can you withdraw it after 30 days? It depends then on AR. If they allow you, you can. If they do not allow you, you cannot. So if you do not withdraw within 30 days, you can proceed with the application. Then the second question you have to ask is whether the question is pending before ITAT or income tax authorities or court, except in case of public sector company. If it involves determination of fair market value, if it is designed for avoidance of tax, except in case of GAR. If the answer is yes, you will not be allowed to make an application. If the answer is no, you can make an application. Then the AR will decide whether to accept it or not. If they do not accept it, they will give you opportunity of being heard. They will give you the reasons for rejection. If they accept it, they will furnish the copy to the AO that this application has been accepted, and they will pronounce the judgment within 6 months of the receipt of application. As I said, it is binding on the applicant in respect of that transaction only, and it is binding on the income tax authority. Clear? So do you have any doubts now? Any doubts? Do you have it? Pooja, you will get transfer pricing notes separately because there will be separate lecture. And advanced ruling are available on ICAI website. Is it clear? Any doubts do you have? No, you will not get refund, Pooja. Any doubts you have with respect to the entire series we have done, you can ask me now. Any doubts? No, no appeal is allowed. Ambika. At most, the writ petitions could be filed. Writ petitions also when no reason is given or no opportunity of being heard is given. Clear, Ambika? Any other doubts? Or we can stop it here if you do not have any doubts. We completed all of it. Yeah. Yes, I wound up.